In 2013, the name Michael Dell wasn't making headlines for innovation. It was making headlines for desperation. His company, Dell Inc., once the darling of Silicon Valley, was hemorrhaging market share, watching its stock price crater, and facing an existential crisis that would make most CEOs update their resumes. The PC market was dying. Smartphones and tablets were eating their lunch. Dell's stock had plummeted from $42 to around $10. Wall Street analysts were practically writing obituaries. Then Michael Dell did something that seemed absolutely insane. He bet everything, his entire fortune, his reputation, his legacy, on a company most experts considered terminal. He orchestrated a $24.9 billion leveraged buyout to take Dell private, fighting off billionaire activist Carl Icahn in a brutal 6-month battle. But that was just the beginning. 3 years later, he doubled down with the $67 billion acquisition of EMC, the largest tech merger in history, piling on mountains of debt that would crush most companies. Today, Michael Dell's net worth exceeds $150 billion. His gamble didn't just pay off. It created one of the greatest business turnarounds in modern history. If this story already has you hooked, hit that like button and subscribe to The Sleeping Economist. We dig deep into the financial mysteries and economic events that shaped our world while most people weren't paying attention. Chapter 1: The Empire Crumbling. To understand the magnitude of what Michael Dell accomplished, you need to understand how far his company had fallen. In the late 1990s and early 2000s, Dell was unstoppable. Michael Dell had revolutionized the computer industry with his direct-to-consumer model, building custom PCs ordered directly by customers and shipping them straight from the factory. No middlemen, no retail markup, just efficiency and profit margins that made competitors weep. By 2005, Dell was the world's largest PC manufacturer, commanding over 18% of the global market. The company's stock traded at all-time highs. Michael Dell, who had started the business in his University of Texas dorm room in 1984 with just $1,000, was one of the richest people on the planet. He had stepped down as CEO in 2004, confident that his leadership team could maintain the momentum. But between 2007 and 2012, everything changed. Apple launched the iPhone in 2007, fundamentally altering how people interacted with technology. The iPad arrived in 2010, and suddenly consumers who once needed a desktop or laptop could accomplish most tasks on sleeker, more portable devices. The PC market, which had grown reliably for decades, began its first sustained decline in history. Dell was hit harder than anyone. By 2012, the company's global PC market share had collapsed to just 10.7%, a catastrophic 12% decline in shipments compared to the previous year, the largest drop among major manufacturers. Revenue projections were missed for 7 consecutive quarters. The stock price, which had peaked around $42 in 2005, languished in the $10 to $14 range by late 2012. In just 5 years, Dell had destroyed nearly $40 billion in market capitalization. Michael Dell, who had returned as CEO in 2007 to try to stop the bleeding, faced a brutal reality. His namesake company was becoming irrelevant. Competitors like HP and Lenovo were stealing market share. The business model that had made Dell revolutionary build-to-order PCs was becoming obsolete as consumers shifted to smartphones and cloud computing. Financial analysts openly questioned whether Dell would survive another decade. But here's what made the situation particularly painful for Michael Dell. He could see what the company needed to do. Dell needed to transform from a PC manufacturer into an enterprise technology and cloud infrastructure company. It needed to acquire companies with capabilities in data storage, virtualization, cybersecurity, and enterprise software. It needed to invest billions in research and development, restructure operations, and completely reinvent itself. None of that could happen as a public company. Wall Street demands quarterly earnings growth. Shareholders want dividends and rising stock prices. Activist investors circle like sharks when they smell blood. The kind of radical, expensive, multi-year transformation Dell needed would tank the stock price in the short term, triggering shareholder lawsuits and hostile takeover attempts. Michael Dell realized he had exactly one option: take the company private, away from the scrutiny of public markets, and rebuild it from the ground up. It would require the biggest bet of his life. Chapter 2. Assembling the deal in August 2012, Michael Dell quietly approached his board of directors with a proposal that made them nervous. He wanted to buy Dell Inc. and take it private. Not just acquire a controlling stake, he wanted to purchase every single share and to list the company from NASDAQ. The numbers were staggering. Dell's market capitalization was approximately $23 billion. But buying out all shareholders would require a significant premium over the trading price. Plus, Michael Dell would need to convince institutional investors to sell. Financial advisors estimated the deal would cost roughly $24 to 25 billion won, of the largest leveraged buyouts since the 2008 financial crisis. Michael Dell couldn't finance this alone. Despite his personal fortune of several billion dollars, he needed partners. He turned to Silver Lake Partners, one of the most prestigious private equity firms specializing in technology investments. Silver Lake saw the potential. If Dell could successfully transform into an enterprise solutions company, the upside was massive. They agreed to co-invest alongside Michael Dell. The structure they designed was brilliant and risky in equal measure. Michael Dell would contribute approximately $750 million of his personal wealth, plus roll over his existing equity stake. Silver Lake would invest around $1.4 billion. Microsoft, seeing strategic value in keeping Dell healthy as a Windows partner, contributed an unusual $2 billion loan. The remaining $15 to $16 billion? Debt. Mountains of leveraged debt that the new private Dell would need to service from operating cash flow. On February 5, 2013, Dell announced the deal: $13.65 per share in cash, valuing the transaction at $24.4 billion. Michael Dell projected confidence in public statements, explaining that going private would allow the company to make bold long-term investments without quarterly earnings pressure. Wall Street's reaction was mixed. Some analysts applauded Michael Dell's vision. Others questioned whether even private ownership could save a dying PC business. But one voice rose above all others with fury: Carl Icahn, the legendary activist investor who had built his reputation destroying management teams he considered incompetent, saw Michael Dell's buyout as a sweetheart deal that undervalued the company. Icahn quickly accumulated a 9% stake in Dell and declared war. He argued that $13.65 per share was highway robbery, that Michael Dell was essentially stealing the company from shareholders at a bargain basement price. What followed was a 6-month corporate battle that made headlines globally. Icahn proposed alternative deals, filed lawsuits, launched media campaigns, and lobbied other major shareholders to reject Michael Dell's offer. Special committee meetings, revised bids, counterproposals. The drama was so intense that CNBC covered it like a heavyweight boxing match. Michael Dell and Silver Lake were forced to sweeten their offer twice, eventually raising the price to $13.75 per share, plus a special dividend, bringing the total deal value to $24.9 billion. On September 12, 2013, after multiple shareholder votes and months of brutal negotiations, Michael Dell finally won. The buyout was approved. Dell Inc. would go private on October 29, 2013. Chapter 3. The $67 billion moonshot. Taking Dell private was only the beginning. Now came the truly terrifying part, the transformation. Michael Dell had convinced Silver Lake and skeptical shareholders that he could turn around the company. Now he actually had to do it. For 2 years, from late 2013 through 2015, Dell operated in relative obscurity as a private company. Without quarterly earnings reports and Wall Street analysts scrutinizing every move, Michael Dell moved fast. He restructured operations, cut costs ruthlessly, and made strategic acquisitions in enterprise, networking, and cloud infrastructure. Companies like SonicWall, Wise Technology, and software-defined networking firms were absorbed into the Dell ecosystem. But Michael Dell knew something bigger was needed. Dell was still too dependent on the declining PC business. To truly compete with enterprise giants like IBM, HP Enterprise, and Cisco, Dell needed scale, capabilities, and technology it didn't have. So Michael Dell started looking for the deal that would either make or break everything. In October 2015, Dell announced something that shocked the technology world. It was acquiring EMC Corporation, the world's leading data storage company, for $67 billion. Not $67 million, billion. With a B, it was the largest technology acquisition in history, dwarfing Microsoft's purchase of LinkedIn or Facebook's acquisition of WhatsApp. The deal was spectacularly complex. EMC wasn't just a storage company. It owned an 80% stake in VMware, the virtualization giant that was itself a public company worth tens of billions. Dell would acquire all of EMC, including that VMware stake, for $33.15 per share. The financing structure involved $49.5 billion in new debt, making the total combined debt load over $50 billion. Let that sink in. Michael Dell, whose company had been struggling to survive just 3 years earlier, was now taking on more debt than some countries' annual GDP. If this gamble failed, Dell Technologies wouldn't just go bankrupt, it would likely trigger a cascade of defaults that could shake financial markets. Financial analysts were stunned. Some called it visionary. Others called it suicide. How would Dell service $50 billion in debt? What if the enterprise market softened? What if the integration failed, as so many massive tech mergers had failed before? The criticism was harsh and unrelenting. Debt rating agencies downgraded Dell's credit. Financial media ran articles with headlines like, "Michael Dell's Dangerous Gamble," and "Is Dell's EMC deal too big to succeed?" Even some Silver Lake partners reportedly had concerns about the scale and timing. But Michael Dell had done the math. EMC gave Dell enterprise storage leadership. VMware gave Dell cloud infrastructure dominance. Together, Dell Technologies could offer end-to-end solutions from PCs to servers, to storage to virtualization to cloud services. The revenue synergies, if executed properly, would be enormous. On September 7, 2016, the deal closed. Dell Technologies was born. The combined company had 140,000 employees and annual revenue of $74 billion. It was also the world's most indebted technology company. Chapter 4. Fighting for Survival. The immediate aftermath of the EMC merger was brutal. Dell Technologies was a private company carrying approximately $50 billion in debt. The annual interest payments alone exceeded $2.5 billion. That's $2.5 billion that had to be paid every single year before Dell could invest in growth, research, or anything else. Wall Street analysts who covered Dell's debt openly speculated about bankruptcy risks. Technology publications ran pieces questioning whether Michael Dell had finally made a mistake too big to fix. The pressure was immense. But something remarkable happened. The integration actually worked. Michael Dell and his leadership team executed one of the cleanest large-scale technology mergers in history. Within the first year, Dell achieved the majority of its promised cost synergies, over $1.7 billion in annual savings from eliminating redundant operations, consolidating supply chains, and streamlining sales organizations. Revenue synergies followed. Dell's sales force could now sell EMC storage and VMware virtualization alongside Dell servers and PCs. Enterprise customers loved the simplified procurement. Instead of buying PCs from Dell, storage from EMC, and virtualization from VMware through 3 different contracts, they could get everything from one vendor with integrated support. By 2017, Dell Technologies was generating approximately $78 billion in annual revenue and producing enough cash flow to aggressively pay down debt. Michael Dell personally took no salary, instead reinvesting everything back into debt reduction and growth initiatives. But being private came with its own set of problems. Private companies have limited access to capital markets. When Dell needed to raise money or refinance debt, options were constrained. Additionally, Dell's ownership of VMware created a complicated structure. VMware remained a public company, but Dell owned 80% of its shares. This tracking stock arrangement satisfied some financial requirements, but created valuation confusion. In 2018, Michael Dell faced another critical decision. Dell Technologies needed more financial flexibility. Debt was declining, but still massive. And Michael Dell realized that returning to public markets would unlock value and give Dell more tools to compete. But how do you take a company public that's already partially public through VMware? Traditional IPOs take months and cost hundreds of millions in fees. So Michael Dell engineered another unconventional solution. In December 2018, Dell Technologies bought back its VMware tracking stock in a $21.7 billion transaction, essentially simplifying its ownership structure. Then, instead of a traditional IPO, Dell issued new shares and returned to the New York Stock Exchange through a technical listing. On December 28, 2018, Dell Technologies began trading again as a public company, ending a 5-year absence from public markets. The stock price opened around $46 per share, valuing Dell Technologies at approximately $36 billion, significantly higher than the $24.9 billion build price just 5 years earlier. Michael Dell's bet was starting to pay off, but the biggest returns were still to come. Chapter 5. The Empire Strikes Back. Between 2018 and 2025, Dell Technologies executed one of the most impressive corporate transformations in modern business history. The struggling PC manufacturer Michael Dell took private in 2013, became a diversified technology powerhouse, competing head-to-head with IBM, HP, and Cisco in enterprise infrastructure. The financial turnaround was staggering. Dell aggressively paid down debt, reducing the load from $50 billion to under $25 billion by 2022. Annual revenue stabilized above $90 billion. Profit margins expanded as Dell shifted away from low-margin consumer PCs toward high-margin enterprise solutions, cloud infrastructure, and services. Then came the AI boom of the 2020s, and Dell was perfectly positioned. Remember all those data center servers, storage systems, and networking equipment from the EMC acquisition? Suddenly, every company on Earth needed them to run artificial intelligence workloads. Dell's Infrastructure Solutions Group, which sold servers and storage to data centers, exploded with growth. By 2024, Dell was reporting record revenues exceeding $90 billion annually. The stock price, which had returned to public markets at $46 in 2018, surged past $100, then $120, reaching highs above $180 by late 2024. Dell Technologies' market capitalization exceeded $95 billion. Michael Dell's personal fortune grew accordingly. His ownership stake in Dell Technologies, combined with his other investments, propelled his net worth to over $150 billion by 2025, making him one of the 10 richest people on Earth. The transformation was complete. The company that had been left for dead in 2012, dismissed as a dinosaur in a dying PC market, had reinvented itself into an AI infrastructure giant. In September 2021, Dell executed one final strategic masterstroke. It spun off VMware as an independent public company, distributing shares to Dell stockholders. This move unlocked an estimated $40 billion in value that had been trapped in the complicated ownership structure. When Broadcom later acquired VMware for $61 billion in 2023, Dell shareholders, including Michael Dell, reaped massive windfalls. Industry analysts who had once questioned whether Dell could survive now wrote glowing profiles of Michael Dell's strategic vision. Harvard Business School developed case studies on the Dell turnaround. Financial journalists called it the deal of the century and the greatest leveraged buyout in technology history. Carl Icahn, the activist investor who had fought so hard against the 2013 privatization, later admitted in interviews that Michael Dell had been right. The $13.75 share price Icahn had called robbery? If those shareholders had held Dell equity through the transformation instead of taking cash, they would have multiplied their investments several times over. Michael Dell had proved everyone wrong. The dying PC company became a $95 billion technology empire. The desperate gamble became a masterclass in corporate strategy. Chapter 6. What we can learn. So what can we learn from Michael Dell's extraordinary turnaround? Lesson 1. Sometimes the best path forward requires going backward first. Michael Dell took his public company private, essentially hitting a reset button on 2 decades of being a public corporation. In your own life, this might mean taking a lower-paying job to learn new skills, going back to school when you're already established, or stepping away from a prestigious position that's no longer serving your goals. Lesson 2. Conventional wisdom is often wrong, especially at inflection points. Every analyst, every financial expert, and every business journalist said PCs were dead and Dell was dying with them. Michael Dell saw something different. He saw that while consumer PCs might decline, enterprise computing was becoming more important, not less. Companies still needed servers, storage, and infrastructure. They just needed different kinds. Lesson 3. Big transformations require big bets and serious conviction. Michael Dell didn't make small adjustments. He bet his entire fortune, took on crushing amounts of debt, and structured deals that would have destroyed him if they failed. There's a difference between reckless gambling and calculated risk-taking. Michael Dell did the math, understood the market dynamics, and had conviction in his strategy. Lesson 4. Timing matters, but so does patience. Michael Dell took 7 years from the 2013 privatization to the 2018 return to public markets to the 2021 VMware spinoff to fully execute his vision. He didn't expect overnight results. He built in phases, achieved milestones, and let the strategy unfold over time. Lesson 5. Sometimes you have to save yourself. Michael Dell could have walked away in 2012. He was already wealthy. He could have retired, blamed market conditions, and protected his reputation. Instead, he risked everything to save the company that bore his name. The Dell story isn't just about technology or finance. It's about resilience, strategic thinking, and the courage to bet on yourself when everyone else has counted you out. It's stories like this where we uncover the economic events that shaped our world while most people weren't paying attention fascinate you. Please like this video and subscribe to the channel because we're just getting started with these financial, educational mysteries.